Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
Hello, I'm Chris Hare, Senior European Economist here at HSBC, and welcome to the Macro Brief, the podcast that looks at the issues driving financial markets. Now, it's been a busy week of central bank decisions here in Europe, with both the Bank of England and ECB holding policy meetings. So on today's podcast, we're going to review the key takeaways, assess the future path of interest rates, and explore whether recent developments at the Federal Reserve could have any spillover effects to Europe. And to do that, I'm joined in the studio by Liz Martins, Senior UK Economist, and Fabio Balboni, Senior Eurozone Economist. Liz and Fabio, welcome.
Thank you.
Thank you.
So there were no policy changes at either the Bank of England or ECB meetings, but that doesn't mean that we're going to have a boring podcast, because there was some interesting news in the communications from both central banks. Let me start with Liz and the Bank of England. The reaction that you put together talked about the Bank of England's comms taking a dovish twist. So what did we learn?
Yeah, that's right, Chris. I mean, the BOE is rarely boring, and today was no exception. So the Bank of England did keep rates on hold as expected, but we had 4 votes for an immediate cut out of 9 members of the committee. So it was quite a tight run thing. And then the Bank of England said, actually, we are more comfortable about inflation. We think wage growth will be consistent with our target by the end of the year. We think inflation 2 years from now will be below our target. And we're worried about things like the labour market as well. So all in all, this was a dovish shift compared with the tone that they struck just a few weeks ago back in December. So I think, lots of risks, lots of uncertainty. But broadly, it's supportive of our own view, which is for slightly more easing than certainly what was priced into the market before this meeting and even than what is priced in now.
So a bit more easing, a bit more in the way of rate cuts from the UK, but particularly given that it was a pretty finely balanced vote, can we say with much confidence when the next cut might be, and also actually where the Bank of England can ultimately get to in terms of interest rates?
Well, I think the first question is a little bit easier than the second. So we are forecasting a cut in April. The market is now almost fully priced for that outcome, although it also has about 60% chance that it could come sooner at the March meeting. You only need one person to switch votes to get that outcome, and both Andrew Bailey and Catherine Mann kind of, from their comments, could switch their votes. So next cut, I think, in the next couple of meetings. Where we get to, I think, is a harder question. And this comes down to what the bank keeps saying. As we get closer to neutral, it gets harder to take these decisions. So our own view is that neutral is 3%, and we will get to that point by the end of the year. But it doesn't matter what we think. What matters is what the Bank of England members think. We know that 2 of the members agree with us that neutral is 3%. Others seem to think it's considerably higher. So it will get harder and is hard to judge where we ultimately end up.
Does it make a big difference? 3% rates, 3.25% interest rates? Does that really matter?
Well, I'm sure the Bank of England would say it matters a very great deal. But realistically, I think, we've been forecasting 3% for a long time. At times, the market had been saying bank rate will never get below 4.25%. So, we're getting down closer and closer to what we ultimately thought would happen. As we get closer to that, the difference gets smaller.
So beyond the humdrum of monetary policy and the rates outlook, Andrew Bailey, Bank of England governor at the press conference, was also asked about political risks and very understandably sort of shied away from the monetary policy implications of those sorts of political developments. But what can we say about the potential economic implications of some of the political volatility here in the UK?
Yeah, well, look, the UK, as has become traditional, is starting to perk up a little bit at the start of the year. So we see the PMI surveys picking up a little bit, loan growth picking up, some of the housing market indicators looking a little better. So hope springs eternal. And, there's a little bit more optimism around the economy as we come into in 2026. As we say, inflation is coming down. We think interest rates are going to continue to come down. All those are good things. but it's a narrow path forward to that recovery and that better year ahead. And one thing that could disrupt it, of course, is political instability. And that's something the UK has seen a lot of over recent years, and it's not helpful for that narrow path towards recovery. So, like Mr. Bailey, we'll be watching developments very closely.
Thank you, Liz. Of course, many risks around the UK outlook, risks which were also discussed by the ECB. And let me turn now to Fabio about the policy decisions there. So no policy changes at the ECB meeting, like the Bank of England. In terms of the overall balance, though, dovish or hawkish?
Yes, thank you, Chris. I mean, the fact that there was no policy change was hardly a surprise. I think the ECB has been keen to remain on hold, and in the account of the December meeting even suggested for an extended period of time if possible. But yeah, the policy statement was maybe a little bit more hawkish than might have been anticipated, and particularly there were a reaffirmation of the resilience of the recovery. There were an underlining of employment being low, solid private sector balance sheet, resilience of the economy, and indeed of more fiscal policy support coming through. So certainly the choice to highlight upside risk to growth relatively to potential downside risk, particularly against what we've seen at the start of the year, so geopolitical risk coming through, does suggest that maybe the ECB is feeling a little bit more confident about the growth outlook, and as such, probably even fewer chances of them potentially cutting rates over the course of this year.
Interesting. So a little bit more confidence in terms of the near-term growth outlook as a reading of how indicators have panned out. Would we share that view? How's the start of 2026 looking?
I mean, the start of 2026, based on the survey, is looking fairly decent. The PMIs were good. They were weaker in France, but we know that might have been related to political uncertainty related to the budget, which eventually was approved and therefore could unwound in February. It is clear that plenty of downside risks remain. We might not still have seen the full extent of the negative impact from US tariffs. Certainly the global backdrop doesn't look like it will be supporting Eurozone growth. But it is fair that certainly certain things are surprising to the downside. And as Christine Lagarde noted today, certainly investment is one of those. And even though we might not be seeing in Europe the same extent of AI-related investment that we're seeing in the US, probably something is happening and is helping kind of lift the growth outlook. The other thing that I would say is that, Christine Lagarde did dismiss the inflation undershooting, which took place in January. Inflation was at 1.7%. The ECB was looking for inflation at 1.9% in Q1 2026. And that in itself is another interesting communication. And Christine Lagarde said we're not going to be held hostage by one inflation print. So clearly in that trade-off between growth and inflation, the ECB at the moment is feeling that even though we might be heading into a period of inflation undershooting, that growth resilience make them feel confident that we will revert back to 2% in a sustainable manner.
So inflation undershooting, or the prospect of it, is one consideration for the ECB. And one potential thing that could drive that is the strength in the euro. We're importing disinflation from abroad. That came up in the press conference. What have we got to say about that?
Absolutely. And surprisingly, Christine Lagarde did respond to that question. Typically, the ECB answer is we did not discuss the exchange rate. And this time, Christine Lagarde said we did discuss the exchange rate. Of course, only insofar as its impact on growth and inflation, which are the things that the ECB would care about. But the thing that Christine Lagarde noted was that at least what we've seen, particularly since last summer, has been pretty much a trend range for the euro. So we obviously have seen a large appreciation of the euro last spring on the back of US tariff announcement and the large German fiscal package announced. But since then, the movement has been minimal, and so she has been sort of dismissing at least what we've seen so far in terms of the potential implication on growth and inflation. Of course, she did suggest that the ECB keeps monitoring those, and certainly what happens at the other side of the pond will be of great interest. And actually, Chris, you did write this week about that, about the implication of the new Fed governor, Kevin Warsh, on those things. So it might be interesting to hear from you on that side.
I did, yes. So it's interesting that both Andrew Bailey at the Bank of England, Christine Lagarde at the ECB were asked about Kevin Warsh, and of course they said we welcome the nominee to become the new Fed chair. They both said, well, we've known him for a very long time. There was praise. But that still means there's uncertainty about what's going to happen at the Fed, and that can pose some risks potentially about what happens in terms of US monetary policy, which could have some spillover effects elsewhere. So in terms of European implications of Kevin Walsh as Fed chair, we've looked at three different things. The first is, what if you do have big US rate cuts? Might you see the dollar weaken? Might you see disinflation imported into Europe? I don't think we put a tremendous amount of weight on those risks. You need some pretty hefty US rate cuts, I think, to really move the dial for Europe. But nevertheless, it's a risk worth considering. I think the thing that's become a little bit more pertinent with the nomination of Kevin Walsh is, well, we have talked about the possibility of a shrinkage in the Federal Reserve's balance sheet. What if that raises long-term interest rates? That could be a challenge for fiscal policymakers in Europe, also a challenge for central banks when they think about their own balance sheet policies. But what if there's a combination of both of those things, rate cuts, QT in the US, and you add on broader economic uncertainties to do with Federal Reserve independence? Now, we see it very much as a tail risk, but if you have a conflagration related to all of that, do you get a whole load of market volatility? Do you get economic spillovers from all of that? Then that really could kind of affect things around the world, and Europe included. So it wasn't such a dull week at all. So thank you very much, Liz and Fabio.
Thank you.
Thank you.
A few quick notices before we go. Don't forget that you can keep up to date on all of our latest reports, videos and podcasts from HSBC Global Investment Research by downloading our app from Apple's App Store or Google Play. If you'd like to know more about what's happening in Asia, then listen to our sister podcast, Under the Banyan Tree, where hosts Fred Newman and Harold van der Linde put the region's economies and markets in perspective. And if you've got any questions or comments, then you can get in touch with us at askresearch@hsbc.com. So that's all we have time for. This week's podcast was hosted by me, Chris Hare, and produced by Tom Barton. Don't forget to like and subscribe to the Macro Brief wherever you get your podcasts. Thanks very much for listening. We'll be back next week.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.